happy Wednesday, everyone, or happy post-Valentine's for some of you romantics out there. This is Ron Williams, technical strategist from MIG Bank based in Switzerland. As always, it's an honor and a pleasure to be speaking with you today on the 15th of February. And our focus today is a very important focus, I think, for 2012, and that is the oil market outlook and price risk amidst heightening geopolitical tension. Now, just before I kick off, I just want to give you some communication details for any questions that you might have, or if you want to stay in touch afterwards. My email address is r.william@migbank.com, r.william@migbank.com. One more time, r.william@migbank.com. Feel free to email me anytime with any questions or anything related to this webinar. And then finally, MIG Bank have their various social media outlets on Facebook. You can find me on Twitter under rwilliam77, and of course on LinkedIn, Ron Williams on there as well. Lastly, forexstreet.net is the blog, very rich blog interface that FX Street has, and on an ad hoc basis, I update very key strategies on that page. Feel free just to send me any responses on that. Okay, oil market outlook and price risks amidst heightening geopolitical tension. That is the focus, and we'll start now. Now, in all my webinars, I give a quick introduction to myself and specifically the techniques that I've been doing all this time. I've been in the market for well over 10 years, working for various institutions, providing short to long-term trading strategies across multi-asset classes. And during that time, as a technical strategist, I have focused on three key areas. Those three areas fall under one key focus, and that is market timing. That is very much an important area for me. And to reach the market timing goal, I focus on cycles, so just being able to understand time cycles, when something is likely to happen, and also correlations between different markets, so those types of cycles. Secondly, patterns in the market and the psychology behind those patterns, but specifically Japanese candlestick patterns, which are very good for short-term trading and for volatile markets, such as the one that we are likely to have this year. And then last but not least, advanced indicators, specifically proprietary indicator called DeMark indicators, which is a suite of indicators designed by Tom DeMark, a very well-known investor and trader, who has spent over 40 years devising market timing indicators, which tend to look for counter-trend reversals in the market. So they tend to look for turning points. So that's basically what I focus on mainly. Of course, there's a lot of classic technical analysis that I use all the time, but these are the three areas under the main focus of market timing. Now, traditional in each of my webinars, I like to find out who is in the room and like to have a two-way conversation with each of you. So I always ask the question, how many of you have attended my webinars before? Are you new to this webinar? And the other part of the question is, where in the world are you from? So if you could just tell me, have you been here before, or is this your first time? And where in the world are you from? So we have a few first-timers. One person, third time for me, from England. Thank you very much, that third-timer. Milan, Italy. A new person from London. A new person from the UK. First time from India. Someone from Africa, London. Old-timer from the UK. Welcome to you too. First time from Munich, Bulgaria. Third time from USA. Any others? So, I mean, first of all, it's fantastic to see each of you here today again. We did change the schedule a little bit from Monday to Wednesday, and then we changed the times from evening GMT to lunchtime. But I appreciate you guys for patiently following up on the change and for being here now. And one of the key points I want to make here is that each and every time we hold these webinars, they are truly global webinars, and we have people from all over the world. Just had one person here just saying a few times before from Japan. Good day to you from Japan. And the key point here is that the capital flow and the mass psychology that we analyze in the market every single day is global. And so it's great to have that global presence here in the webinar. And please keep that in mind when we're looking at investment opportunities. There might be certain investment opportunities you want to know about. And please ask questions about those with regards to which markets you're most interested in and which country you're calling in from. So welcome to the world. And we will continue now MIG Bank webinar in association with FX Street on oil. Now we're just going to have a just quick disclaimer note. No information published constitutes solicitation to offer or recommendation, advice to buy or sell. And certainly the information here is just for educational purposes. Now, there are three parts to this webinar, as always. First part is a big picture focus. Looking at what does oil market cycle suggest. Remember, cycles is a big part of my analysis. Key levels to watch. Part two, key market indicators. We're going to look at a few interesting things such as Brent and West Texas oil spread. A chart on volatility and what that says about the risks of an oil price spike over the coming months this year. And part three, a geopolitical update. I'm just going to make a quick point about what everyone is aware of from watching the news in terms of what is the news and how, as investors and traders, we can maybe prepare for potential risks out there in the market, tail risks in the market, and in this certain topic, geopolitical risk. And the last point I'm going to make here is what does it mean for the markets? Because ultimately we need to trade and invest. So what does this mean for our portfolios? What does this mean for our trading opportunities out there? So part one, big picture on oil. Part two, key market indicators to watch as things develop over the next few months. Part three, of course, we need to just be aware of the geopolitical risks, especially when looking at the oil market. Okay, so I'm going to begin with this theoretical roadmap of my cycle analysis. Some of you who have attended previous webinars might remember this from before, but I bring it up again just to really crystallize the focus of what might happen in the months ahead. Now, these are three cycles that we're looking at on the chart. The big fat blue line is the long-term cycle. The thin light blue line is medium-term cycle, and the red dotted line is short-term cycle. Now, there are various ways that you can look at the time frames, but just think of long-term as multi-year, medium-term as several months, and short-term anything from a few weeks to a few months. Now, on this roadmap, I believe that the Western economy is roughly there. Now, remember, this is just a theoretical diagram that hopefully just allows you to understand what is likely to happen in the coming weeks and months. So we're currently on the down part of the long-term cycle and the medium-term cycle, but you can see there the red dotted short-term cycle is that kind of positive rally or recovery stage that we're seeing in some of the popular markets, certainly the risk markets like the equity markets, like certain currencies such as the euro, and maybe some markets, commodity markets like gold, and so on. Now, this is where we have come from, 2007, at the start of the financial crisis. Certainly, we could all maybe agree that was at the top of this multiple cycle. We had the big fall, which ended in 2009, and then the big recovery, which took us into the early part of 2011. Now, it's the second half of 2011 which a lot of traditional trends changed, and they changed to the downside. And now we're in that up phase on the short-term basis. And basically the big question mark now is that as we close the first quarter of this year, what is the second quarter of 2012 likely to hold for investors and traders? And my thesis has long been that the second quarter is likely to be where we see just a little pullback or big setbacks in certain markets which have been quite strong over the last few weeks and months. So is that clear to everyone? Can you just get a few yeses? So at the moment, we're still in the positive stage on the short-term recovery, but watch out over the next few weeks and months into the second quarter of 2012, where we're likely to see some downside surprises on some of the markets which have been quite strong, and that does include the equity market, that does include commodities such as gold and silver, that does include euro, further weakness in the euro. On the other side of that equation, it is likely to mean further strength for the US dollar and most things against the US dollar. Is everyone okay on that start point? It's just a quick point that I want to focus on. Do you think it will be that soon? The default from Greece has been pushed back a bit. Good point there, and there's a chart that I'll prepare for the next webinar, which is going to be focusing on the stock market. Think of the Greek deal, the recent Greek deal, as a last stage of optimism in the market. There's a chart I have which I showed on CNBC media interview on Squawk Box just this Monday, which shows how the Greek deals historically have tended to highlight a market top. So think of it as a potential contrarian signal. Okay, in terms of that. I'll move on swiftly, but I take your point. There is a lot of optimism out there, but I'm just going to focus, at least for this presentation, on the second quarter of this year, which just from a technical perspective, the market is due a healthy setback over the next few weeks and months. And from a sentiment perspective, the Greek optimism after the austerity bill was approved can and may likely highlight a market top on the equity market. Okay, and just keep in mind this cycle roadmap which I've just shown you. Now, let's jump straight onto oil, which is the purpose of this webinar. Oil, and this is oil, West Texas oil, has been under pressure at $100. And we can see there that $100 psychological level, which also acts as a important golden ratio level. The market has been oscillating around the $100 psychological level for some time within a trading range. And we can see that trading range has been holding for about 3 months or so. Keep in mind that the event risk that we're talking about, the EU-Iranian Oil Embargo announcement, came out on the 23rd of January within this range, and there hasn't been that much geopolitical risk priced into the oil market, despite what popular opinions have been voiced on this. There has been little geopolitical risk priced into the oil market, at least in my opinion. And you can see why I might be saying that, as oil has been holding within this neutral trading range, which has been oscillating around the $100 psychological level. Now, I do want to say more than that. I think in the short term, we see potential weakness into this key $90 level, something I call a structural level, where resistance becomes support and vice versa. There may be a potential dip even lower into the lows of last year, spring last year, where we had the Libyan crisis, the Arab Spring, and that price level is around $83. So in the short term, there are downside risks on oil, but I think that afterwards, you see the red arrow there just highlighting the short-term projections, more than likely there'll be growing upside pressure where we might actually challenge the April 2011 peak at $114, and of course much higher than that from thereafter. So that's my short and then medium-term outlook on oil, West Texas oil, currently under pressure at $100 within the trading range, and at the moment we might see some near-term weakness into $90, potentially $83, but big picture, I believe this trading range will break to the upside challenge the April 2011 peak at $114. And once we get to that stage, we can get a lot more positive on the upside. Now there's a question here, do large cycles usually last for 7 years from the bottom to the top and 7 years from the top to the bottom? How many regularly? Let me come back to that a little later. But yeah, it depends on your time horizon, and there are many time frames of cycles I look at. For the moment, I'm just showing you about a year or two's worth of information, but I'll show you a very long-term cycle chart on oil at the end of this webinar, so stay tuned for that. Okay, now this is West Texas oil under pressure around that $100 level. It's a slightly different scenario when you look at it on a long-term basis. It's a lot more bullish. Now this is the same chart, but this is a weekly chart going back to 2008. And the very important thing here is the major capitulation, the major drawdown that we saw in 2008 during the financial crisis, where oil capitulated by about 70 or so percent. What I have done is picked out the halfway mark, the halfway retracement of that decline, and highlighted it there in the blue dashed line. And that is roughly around the $89 or $90 mark. $90 on oil is very important on West Texas oil. That works out as the average to 50% halfway mark of the major decline that we saw in 2008. And in a lot of research that I've done, these halfway levels are very important. And certainly how the market reacts to these halfway levels is also important and tells us something about future movement. Now, the fact that oil is holding above this halfway mark or $90 mark is positive, and as it holds above that and the $80 mark, which is the trend line support that you can see there coming in from 2009, oil is looking bullish, the trend is up, and the risks for a price spike are always going to exist. At the moment, they are small risks, but still growing risks over the coming months. So just a key point to keep there on West Texas oil, long-term chart, weekly chart from 2008. If you look at the decline during the financial crisis of 2008 and divide that in half, that halfway mark is important. It translates to around $90. And while oil holds above $90 and then $80, the trend line support, we are positive on oil over the next weeks and months. Is that clear to everyone? Just get a few yeses. Is that okay? And just one quick question there that I will answer. Haven't the Middle East expressed a preference for $90 minimum as well? Would that have an effect on WTI performance around that level? I've been asked that question by various journalists very recently, and that is a good question. I think Middle East oil ministers have expressed $100 or maybe $90 as an important cap on the oil market. I believe that they, of course, have plenty of political influence on the supply side of oil movement, but I believe that influence is only short-term. The long-term effects of a trend are very much driven by mass psychology and capital flows from around the world. So I'm of the opinion that politicians, oil ministers, and supply side influences only impact oil and every other market in the short term. So everything else I really believe is down to investors and traders and the money that they put behind this this commodity. So I hope that helps answer your question. It will affect in the short term, but not in the development of the trend, which I believe will continue higher. Okay? Now, interestingly, just one thing I missed off is the timing indicators that I look at. Remember I mentioned the market indicators. We had two exhaustion signals appear around the top of that trading range, which you probably remember from the short-term chart I showed you, but roughly around the $103 mark. And so we've just had some very near-term resistance at those levels, but I believe that is short-lived, and we should push back much higher. You can see there the next level is $120, and that's the retracement level from that 2008 decline. Now, it is a completely different story when we look at Brent crude oil. And one quick point I want to make is West Texas, of course, is and there are two different types of oil contracts you can get. West Texas out in the States, and then Brent crude, which is a composite made up of various supply chains, but one of which is actually derived from the Middle East. So Brent crude oil tends to be more sensitive to geopolitical risk in the Middle East. Now, of course, the difference between West Texas oil and Brent crude oil is the quality of the oil and how it's actually irrigated out of the land or sea. But it's also important to keep in mind where from the world it's actually taken from. And with regards to Brent crude oil, it's quite sensitive to the Middle East because part of its composite supply is from that part of the world which tends to have geopolitical risk inbuilt as a premium. Now, what we see here is more of a positive picture on Brent oil. This is a daily chart of the same time period as the previous chart that we looked at. And you can see here that it has already broken out of this huge channel on a weekly chart or longer term chart. You could call it a flag continuation pattern. But either way, it's positive. We're trading around $118, which is roughly a $20 premium to the West Texas oil contract. So this is already $20 more expensive than the West Texas oil contract, and a lot more positive. Now that positivity is potentially down to more geopolitical risk being priced in onto this contract. But just keep in mind, technically speaking, it is more positive. Now, what I have done here is I have put the same chart, Brent crude oil, but now I'm showing it to you in a different currency. So the previous two charts, I was showing you oil priced in the US dollar, which is the traditional currency of value. But here I'm showing you oil, Brent crude oil, priced in euro terms. Now there's a key reason for this. Can anyone tell me why it might be interesting to look at oil in the single currency euro at this moment in time? Why might that be interesting? It's on the screen, but I just want to get some feedback from some people. Anyone want to give me their view? Why might it be interesting to look at oil priced in euro? Anyone want to maybe just come back with a comment? I'll just keep it open. It's cheaper. It's actually more expensive. I would say shows euro versus US dollar value relatively. Yeah, it's a relative game that we're looking at, and I would really encourage you to look at your market in different currency terms because it will give you a lead or a lag signal as to the performance of that market, and of course the currency effects that might be magnifying the move on that market, strong or weak. And what this shows is that oil, Brent crude oil, looks a lot more powerful when it's priced in euro terms. You can see that technically it looks more powerful because it is actually holding at the 2008 peak level. Now, neither of the other charts I showed you, West Texas oil or Brent crude oil priced in US dollar, is trading at the 2008 peak. That's actually a major bullish elevation of the trend. It's at very high levels. Being at the 2008 peak. Remember, that was where we had the major decline during the financial crisis. Now, the main reason why we're ranging near the 2008 peak, and we have done for almost a year, is because the euro has depreciated by up to 15% since 2011. And what that does is it shows you the currency effect of a weak euro, and it magnifies oil's upside favor. It also tells you something from a macro perspective, that the European nations are likely to have a lot of pressure from existing oil prices because their currency is that much weaker. And so from an importing perspective, their purchasing power is slightly more weaker because the currencies are losing value day by day. Okay? But the key message here is look at all your markets in other currency terms when you do this on the oil market, you can see that it's a lot more bullish when you change it from US dollar to euro, and that's of course because of the currency effect of a devaluing currency. And it also tells you from a macro perspective the pressures that those economies might be taking on board with regards to how their currency has changed and the purchasing power of the currency. Is that okay for everyone? Just get a few yeses before I move on. Yep. Okay. Thanks. Okay. Next one. We're on to part 2 now. And so part 1, we just looked at the big picture. Part 2, we're going to look at key market indicators. I've only included 2 charts in this. The spread of Brent and West Texas oil, which we've already spoken about some time. And then the key message behind this entire webinar is in the chart of volatility. This is oil's volatility and the risks of an oil price spike, which is probably the question that each of you are asking yourselves after the various news that you've heard recently. Okay, so that's part 2. So part 2, we jump into another chart, and this is a chart of the spread I was talking to you about. This is the difference between Brent crude oil and West Texas crude oil, the difference between the two. Now, the green area, whenever this chart moves to the upside, that is showing you Brent crude oil trading above or at a premium over West Texas. So it's just showing you the green area. Whenever this chart moves up higher, it's showing you Brent crude oil outperforming West Texas. Now, look at the white rectangle area there where I've highlighted on the chart, and I've labeled normal oil spread tends to range around $5 plus or minus. Now that is the normal spread between these two oil contracts based upon the history that I'm looking at. Everything else is abnormal, and that abnormal increase in the difference between these two oil contracts took place early last year when we had 2 big black swan events. The Arab Spring, or the revolution in the Middle East, which was in early spring. You can see how the spread increased quite violently higher, and then that was then magnified even more once we had the Japanese earthquake. So you can see how geopolitical and natural disasters helps really trigger an acceleration in this spread. Now the spread eventually pushed to a record level of $27. So Brent crude oil was at a $27 premium over West Texas. And the key message here is look at this spread, because it is likely to give you a leading indication as to what happens over the next few months and how the market is pricing in any geopolitical risk. Now currently the spread is actually much higher, around the $20 mark, but this chart's a little bit out of date. Remember, Brent crude is trading around 118, and West Texas is roughly around the $100 mark. So roughly $18 to $20 difference. But just keep in mind, this spread is one to watch. A lot of traders look at this ratio just to get an idea of sentiment, but also sometimes to work out which oil contract to trade when they want to actually take advantage of any potential opportunities out there. Any questions on this? Any questions on this chart? Okay, I'm going to quickly shift on to the next chart. The next chart is the most important chart, so please stay focused on this next chart, and that is oil volatility. Oil volatility as measured over the last 10 years. So this is showing you 10 years worth of volatility on oil, West Texas oil, for those of you who might want to know. But interestingly, what it shows is 2 things. One, price spikes in oil are regular and cyclical. I'm going to say that again. Price spikes in oil are regular, they happen regularly, and they are cyclical. One last time. Price spikes in oil are regular and they are cyclical. So, I mean exactly what I'm saying. And you can see there the red arrows I've highlighted there, just showing you whenever oil has spiked in price value, and I've quantified it by +1 standard deviation, and then even higher, +2 standard deviation. And that has happened roughly every 1 to 2 years on oil. You'll see this on West Texas, on Brent, on all the oil contracts. It's a cyclical occurrence that takes place in the market and a regular occurrence. So we should really accept the reality that price spikes in oil do happen, and by actually accepting that reality that we have seen throughout history, especially when we look at this volatility chart, it would be a good idea to prepare for them and to try and quantify how those price spikes actually take place. So obviously, one price spike might be larger than another or smaller than another. It's all relative according to what happens on that given day, but it is a common characteristic in the oil market. Now, the second point is that currently we are actually trading, oil is trading below the 10-year average of volatility. So oil's volatility is at the moment below the 10-year average, which is quite surprising given this renewed geopolitical risk, which is growing has been growing over the last few weeks, and obviously into the new deadline that has been given 1st of July, when the European nations look to actually launch this embargo against Iran for its potential nuclear capability. Now, from a trading perspective, this is an interesting mean reversion setup. So because we are at historically low volatility levels, this opens up the probability, small at the moment, but growing probability, for a reversion back to the mean, and of course that potential price spike which is due in terms of timing, because we haven't had one for some time now. Okay, so is everyone okay with this chart? It's just a statistical chart showing you oil's volatility on a historic basis, and it shows that oil tends to spike on a regular basis. Cyclically, there's a rhythm to these spikes in oil. They tend to deviate up to +1 to +2 standard deviations, and currently oil's volatility is below the historical 10-year average, and so that might open up a growing probability of a mean reversion setup over the next few months. Now, there's a question: $50 to $20 is volatility range band, so oil may move up to $150 is a normal move. Not really. I would say no to that question. Keep in mind that 2008 was a big event shock. That was the financial crisis, and so that skews the data a little bit. But certainly you can have moves of the $20 mark in terms of kind of additional price gain, an additional $20 price gain on oil. The most important thing here, everyone, that I must stress is it's not so much the value of oil, it's the speed at which oil moves that matters. A lot of people, especially some of the big kind of market experts and institutions out there, are talking about really big levels that oil can attain over the next few months. And certainly if you get a price spike, some people are saying $150, some people are saying $200 on West Texas. But these are levels, and of course levels do matter. But what is more important is how fast we move in the oil market. If we get a price spike, the sheer acceleration in price value is what is likely to impact the markets most, not the price value. Economists tend to talk about the price value and how that's going to affect economic growth and stock markets and various other related areas and factors. But keep in mind that, at least from a technical perspective, what is very important is how fast oil accelerates, i.e., do we see a price spike? Because it is the actual nature of a price spike in oil, even if it's $10 or $20, the violence of that price spike that really impacts market psychology and capital flows around the world. Is that clear to everyone? That's actually quite an important point that I want to make out there, because a lot of the time we anchor our thoughts on how high will oil move, but we forget the time factor. How quickly oil moves is actually, I would say, more important than how high oil reaches in price value, because that is likely to create more of a market shock in terms of investor psychology and capital flows, where we decide to put our money when that happens, because of course that's more of a dramatic event that will catch us by surprise and then force us to react according to what we believe is the best thing to do at that given moment. Okay, so this chart is basically, in a nutshell, oil volatility over the last 10 years, currently trading below the 10-year average, suggesting that there is potential, small at the moment, but growing potential for a mean reversion and price spike over the coming months into the latter part of 2012. Now, part 3, I'm just going to focus the remaining part of the presentation on the geopolitical situation, so just the headlines that have been out there and just a few kind of interesting points. And I'm going to end off on what it might mean for the markets, and then I'm going to end off with a big picture long-term cycle on oil. We should have time, plenty of time for questions. I've kept this quite short, just so we can have a bit more interactive questions throughout this webinar. Okay, so part 3, geopolitical update. Now, before I launch into the headlines, which we've all been listening to and continue to, keep in mind risk scenarios. I keep mentioning this in some of my webinars. All we're talking about here is a potential risk scenario in the market. That risk scenario might be market related, it might be economic related, it might be politically related. It doesn't really matter. As a trader and investor, these are risks that we just want to be aware of, and most importantly, we want to prepare for, just to make sure that we can survive for the next trading opportunity, or in some cases, if we're lucky, actually take advantage of this potential risk and maybe be on the right side of the trade. So that's why discussing these risks is so important. And just think of it as a risk. It's a risk. It could be a price risk or an external political, economic, social risk. It doesn't really matter, but it's a risk out there. And this chart here is showing you statistically how risk can be measured. And this is a probability distribution, the red probability curve. And this is the probability distribution that best describes the financial market. You can see that the ends of this diagram are quite long, and otherwise we refer to it as the tails of probability, or the fat tail, the black swan event. You can see there the white and black swan I've illustrated on the chart. And so this allows for a lot more market shocks to take place. So that's basically what this distribution diagram shows. The long tails allow for more larger and frequent market shocks, like the ones we've seen in the financial crisis, like the one we saw in the technology crash and various other market crashes that we've seen, but also certain geopolitical risks or even natural disasters, like, for example, the earthquake in Japan that we unfortunately saw early last year. So all these big surprise events can be illustrated statistically in this probability distribution. Now the problem is this picture here, which I'm showing you, and this is just a little light humor that I'm including in the webinar discussion. 2012, similar to previous years, is a year where we have plenty of risks. And because we've had so many risks past and still existing, a lot of people are becoming more isolated to one side of the trade or to one view. They're preferring to hear no evil, say no evil, and see no evil. And that's basically why I'm showing you this ancient Japanese diagram based on an ancient Chinese proverb, three monkeys. Just a light humor as to maybe what a lot of us in the market are doing at the moment, prefer to do. We're preferring to look at the profits that we've made. Certainly, if you look at the stock market, we're back at the old highs from 2011, and certain other markets are holding their trends very well. So we're fairly happy fairly optimistic. From an economic perspective, we've had the Greek deal just approved, the austerity bill, which is actually very positive news, and various other things which look positive. The presidential election this year is also another positive because it means that the United States is likely to spend more money on the economy. One person here saying, Lordy, I'm not positive. Of course, there are two sides to this story, but the point that I'm making here is that there's a growing number of analysts, but also investors and traders, including myself at some stages in my analysis, that prefer not to talk about the risks, hear the risks, or see the risks. So, like humor, see no evil, hear no evil, say no evil. It's a proverb that we all know, and just keep in mind that we want to stay optimistic. We want to look for the nice, exciting trades out there. But my one point as a trader and as a strategist here at MIT Bank is look at both sides of the trade. Even if you're in the money and you're in a profitable trade, just be aware of the risks of that trade because it is likely to keep you in the game longer. So if there's another message that you can take away from me today, please crystallize that message I just said. Look at both sides of the trade. I'm happy on a spiritual and philosophical level to be optimistic. I'm a very happy person. But I also like to be aware of the risks out there. Try not to get in the car without looking out of the window. It is important to be aware of the various kind of issues that we might have there. Someone's asking, can you do a webinar on gold? Yes, I did one previously last year, and it definitely requires an update. Maybe if there's some time at the end of this webinar, I can just mention one or two points about gold. Okay, so just a quick point on a very kind of light-humored point that we should be aware of risks on both sides of the trade. And while we're still making money at the moment in certainly the equity markets at the old highs and some of the other markets which are holding up like gold, we should be very much focused on any potential downside risk. Now, part of the reason why we're not focused on the downside risks at the moment is because of this volatility index, the VIX index, otherwise known as the fear indicator, which is at historic lows. So yet again, volatility is at historic lows, or relatively speaking, back to the levels last seen in 2011. And to most of you, this is very good. Volatility is low. It allows for easier trading and investing. The trends are a lot more cleaner and more predictable during low volatility environments. But key point here, you need to be looking at this chart in exactly the opposite way. Whenever this chart reaches the bottom part of its support level or trading range, that should be treated as a potential for further increased volatility. That's how you should be reading this chart. So it should be read in a very different way to how you analyze a price chart. Remember, this is the chart of volatility as measured from the US equity market. Now, what I've done is I've highlighted, I'm measuring this volatility using an indicator, and the lower indicator there, you see the red line in the bottom axis, is showing you the spread, the increase and decrease, the change of volatility of the VIX. So it's an indicator on an indicator. And the reason why I'm showing this chart is just basically it's showing you previous times that we've had a big increase in volatility based upon the VIX index. And it gives you a potential signal for increased volatility over the coming months. Now, from a seasonal perspective, what's interesting is that previous examples in the last 2 years, volatility has tended to increase during the spring months. So, 2010, volatility increased during April and May. 2011, volatility increased between March and April. This time, we've actually had volatility drop off for several months, and we're back to lows last seen in early 2011. So I believe now, if we do get an increase in volatility, it's likely to be much bigger, and it's likely to be sooner. So potentially in the coming weeks during February, but more than likely within the month of March. and April and May. So during those periods, I see an increase in volatility based upon this index, but also based upon a lot of my cycle analysis across many markets. Volatility is likely to increase over the next few months and is likely to make a big move into the summer period, where some markets are likely to end their setbacks and create potential buying opportunities into the second half of next year. Okay, so is everyone okay on this chart? Someone's just said gold is still a bull run. Yeah, gold is still on a bull run, but there's some downside risk in the short term that I'm looking at. I can maybe mention at the end. Okay, so the VIX is telling us what we already know, that we are comfortable at the moment because volatility is low, the trends are clean, that they're easy to identify, and certainly if you look at some of the markets, like the equity markets, we are back at the old highs, and most people have made profits in the equity markets and various other markets like gold and so on. But things can change very quickly if volatility increases over the coming weeks and months, and the VIX is a great indicator for that. The chart I'm showing you here shows you the potential for increased volatility over the next few weeks and months. Now let's go on to the geopolitical situation. I'm by no means a political expert, and then I do not want to get involved in geopolitical speculation, but I'm just here just firing out a few points to consider when we're watching the news. EU-Iranian Oil Embargo, what it basically means is, of course, if you just look in the yellow section there, I've written a few notes. Basically, Iran is believed to be developing nuclear resources for various reasons, but the concern is it might be for nuclear weapons. On the back of that, there have been several sanctions which have been put in place, economic and political sanctions on Iran, and probably in a lot more of a unified approach, the European nations have decided to formally launch an oil embargo against Iran, i.e. they will stop buying oil from Iran. Now this is something that the United States has already done, and they did back in early 1980, I think 1982. And so this would just basically be more of a unified effort to pressure Iran to change its status quo. Now, the deadline, as mentioned late January, was July 1st. The reason why it was put forward is because some of the countries within Europe that were likely to become part of this oil embargo within Europe wanted time to make adjustments to their oil supplies, because of course changing where you buy oil in very large quantities isn't something that can be done overnight. It needs time. And those countries were actually Greece and Italy, Greece being actually one of the biggest European buyers of Iranian oil. And you can imagine that being within the peripheral kind of region of Europe where they have a lot of economic challenges, changing oil suppliers could easily put them into even more economic pressure. So they needed more time to look for potential new suppliers for oil. And yes, as someone just said, Greece is very exposed in this particular example. Now, the key suppliers of oil, if they were to stop buying from Iran, is Saudi Arabia, the Kingdom of Saudi Arabia. And so that's good news in terms of keeping this oil embargo as smooth as possible without creating any oil price shocks. And in terms of the demand side, people that stop buying from Iran, that demand that is likely to be picked up by countries like China, which has vetoed an embargo against Iran, and are more than happy to buy more oil from them, as I think the market headlines have reported. Now, of course, the big wildcard question, and this is open to speculation, is there has been some rhetoric from Iran that there might be a reaction, a political reaction, if an oil embargo were to take place, or if further extreme measures were taken against Iran. In that extreme situation, there has been rumors or official statements that they may close down part of an area called the Strait of Hormuz, which is part of the Persian Gulf area, and a major supply area for oil, not just for Iran, but also for Iraq, Kuwait, and Saudi Arabia. So that entire Gulf area would have their exports stopped for a certain amount of time. Of course, that would be a big challenge. I don't think that would last for long, and many political commentators are saying, one, it's just political rhetoric; two, that would only happen in an extreme situation; and three, if it did, it wouldn't be sustained for that long, because of course it would mean that the situation accelerates to new levels of geopolitical risk. But as a market technician, and speaking to you traders and investors out there, the key message is, how will the market react if any of this takes place as a market headline or as a market reality? And so that's the key question. Just think to yourself, as the days, weeks, and months develop into this July 1st deadline for this EU-Iranian oil embargo, how is mass psychology out there in the market, and capital flows that drive mass psychology, i.e. the money behind the decisions, how is that likely to be impacted by any of this geopolitical risk? So it's just important just to kind of keep yourself aware of the situation and look at both sides of the trade. Again, that's my only message here. Try not to be like the three monkeys, hear no evil, see no evil, and say no evil. Be optimistic, be happy, but just be aware of the risks out there, in addition to all the other risks that exist in the market for 2012. Now, if we were to have a price spike in oil for whatever reason, be it because of supply side challenges or political reactions such as closing down temporarily of parts of the Gulf Arabian Sea, and then obviously the actual delivery of oil, if we were to see a price spike for whatever reason, or if it's just a market move, a natural market move because of a market cycle, keep in mind what that would mean for all the other markets that you like to trade. And so I've just quickly put this diagram together. Of course, a price spike in oil or further increase in oil over, let's say, the next few months is likely to create further upside potential for gold. Now, I believe this is likely to happen around the summer period of this year. On a cycle basis, I am actually short-term concerned on the downside on gold. You need to be watching the key level at 1810 on gold. While gold holds below 1810, the downside risk in the short term still exists for a potential setback, a healthy setback into the 1430 area and potentially 1300, which I know a big move. But that would set up a very good buying opportunity into the summer of this year, 2012, when we may potentially get this geopolitical risk coincide, or just the general market dynamics of gold pushing higher back above the $2,000 level. On the other side of the coin, any potential price spike in oil or acceleration in oil will be negative, likely be negative for the US dollar and certainly for equities, certainly Western equities. So just keep in mind, US dollar tends to depreciate during these types of big moves in commodities, because commodities are priced in US dollars, so there tends to be an inverse relationship. However, on the other side of that equation, there may be an exception to the rule, and US dollar might actually be positive in a potential flight to safety reaction by the market. So if the market actually wants to run and hide into a safe haven, it may choose the US dollar. So in a very strange and twisted way, in a non-traditional way, US dollar may prove to be an exception to the rule. and still be positive with high oil prices because of the safe haven idea. Keep in mind that other traditional safe havens such as gold, such as Swiss franc, and such as the Japanese yen, these markets are actually in transitionary stages at the moment, and a lot of investors and traders have moved away from traditional safe haven assets like gold after the big correction, 20% in 1 week, after Swiss franc depreciated against the dollar by up to 34%, after the Swiss National Bank intervened on Euro Swiss, and on the Japanese yen, I'm holding a very long-term view that we're going to get a major cycle reversal in the Japanese yen, so Japanese yen weakness. And of course, a lot of you will probably see that on the dollar yen chart, which is just pushed above its long-term 200-day moving average for the first time in almost a year. I can send you more information about that later on. But just to keep in mind, positive for gold, potentially negative for US dollar, and definitely negative for equity. I'm just going to quickly wrap up. It's also negative for economic growth, and this is a chart of US GDP. Anytime we are below that red line, it is negative GDP growth, negative economic growth, and it also classes a recession if it's below that red zero line for more than 2 quarters. And the key point I want to make here is that 1980s we had a double dip recession. Part of the reason why we had a double dip recession is because of a similar situation where the United States actually launched its oil embargo against Iran, and that created a price spike in oil. That then created massive inflation, which then created a lot of downside pressure on economic growth, and in the end, a double dip recession. So that's recessionary risks as well. If we were to see a price spike in oil, of course, high oil prices and a price spike in oil can do a lot of harm to the economy, and that's why this is such an important risk to be preparing for, or just to be aware of. And this is the same chart, but I've just annotated a lot more on it, just showing you previous recessions in the US, why they have been created, and just a few cycle points I put on there. We don't have time to go into this, but you might want to watch the video again at the end of this webinar. It is recorded, and then you can maybe stop and watch this chart later on. Now, the very last chart I'm going to show you is that long-term chart of oil, and you can see here, this is all going back to the 1970s even. It's one of my favorite charts of oil, and it's a long-term chart of oil showing you bull cycles and bear cycles. The yellow area, yellow highlight, is showing you economic recessions, and yes, price spikes in oil does lead to economic recessions. You can see that throughout history. And then I've just also highlighted the various political wars that took place during that time. The recent acceleration in oil last year was down to the revolutionary tsunami in the Middle East and North Africa, the Arab Spring. During the 90s, it was the Persian Gulf War, and then even before then, we had the Yom Kippur War and the oil embargo given by the United States in the early 80s. So again, look at this chart after the webinar on the video if you're interested. These cycles tend to last up to 20 years, and currently, if I'm measuring the cycle from 1999, we have only been in a bull cycle for about 13 years, which is just over half of a normal long-term cycle on oil, as I've illustrated here on the side. So roughly 20 years in either a bull phase or on a bear phase, positive or negative, and we're currently just over half of that bull phase. So just from a long-term time cycle perspective, there is more upside, more time for oil to move further higher, and there are risks for a price spike, small but growing, as we can see on this chart. Now, that's it from me. I'm going to end off on my mantra, my philosophical mantra: enlightenment to realize knowledge. Any questions? We've run out of time. Just please feel free to email me on my corporate email account. And please sign in to the next webinar, which is scheduled for the 14th of March, the bear cycle on equities and related risk markets. There will be a market update a point about a game of 1/4 during 2011. What do macro cycles suggest about Western equity market, US stocks, and the technology sector? And then finally, trading opportunities. Please feel free to email me with any questions on r.william@mitbank.com. Again, MIG Bank is also on social media, Facebook. I'm on Twitter, rwilliam77, where you can get more real-time alerts from me, and LinkedIn, Ron William on LinkedIn. And then, of course, last but not least, forexstreet.net is the blog that I follow, I contribute to on FX Street. Thank you very much. Please sign up on that webinar for 14th of March, 4 o'clock GMT. The FX Street team have just put the link in there, so feel free to sign up sooner rather than later. We get a lot of attendees, and we just want to make sure that continues. And just very lastly, if you have any additional questions, or if you're interested in any of the charts I've discussed, or if you would like any of our daily reports, again, just email me on the details I mentioned, r.william@migbank.com. I'm happy to answer any questions I haven't been able to answer now. Thank you so much for attending. Happy greetings from Switzerland. Happy post-Valentine's to some of you romantics out there. And thank you very much for attending. It's been an honor and a pleasure, as always. Thank you, FX Street, as well, for allowing us to host this. Once again, MIG Bank in association with FX Street. Thank you. Bye-bye.